Okay, let's look at setting up an allowance for bad debt account. We'll first look at percentage of sales method. This is the one that is focused on the income statement, so it's paying attention to the income statement. We estimate that $7,000 is going to go bad. That's based on looking at sales. Notice you're looking at sales, not anything in the balance sheet. The allowance for uncollectible accounts prior to this adjustment that you're going to make, this prediction of bad debt going forward, has a debit balance of $3,000. Using the percentage of sales method, however, you ignore this. This is not something, you don't pay attention to the debit that's sitting in the allowance for uncollectible accounts. So this I'm going to designate red because we're not paying attention to it. The accounts receivable balance is $50,000. The estimated amount of bad debt is booked as. So this one, this one of the reasons the percentage of sales method is considered to be easier is you basically take sales, multiply it by some kind of factor, 0.004, 0.04, whatever you think is going to go bad in those sales. In this case, they tell you what it is. They say $7,000 is going to go bad, and you just make an entry for it. It's very simple. You make a debit to bad debt expense, and you make a credit to allowance for bad debt. That's how you fill this tank up. Keep in mind that you're crediting this allowance for bad debt. As you write off receivables in the future, you will debit however much the receivable is you're not going to collect. You're credited it here, you're going to debit it in the future, and then you're going to credit the accounts receivable. So under this example, let's say, I don't know, $100 goes bad. Well, then you're going to debit allowance for bad debt for $100. That's a debit. And then you actually take the receivable off the books. You have to take the receivable off the books when you write it off. That means you're not going to collect it. But you'll notice that your recognition of bad debt expense is done at the end of the year when you project out to investors, this is how much of our bad debt is going to go bad. If you decided to write this off, you know, if you basically took expense every time that you wrote off a receivable, if you did this, for example, you didn't use an allowance account and you did bad debt expense. If you did that, then you wouldn't have matching. In other words, this would be subject to when you made the decision to write off that accounts receivable, and you wouldn't be matching the revenues that are connected to that transaction. Let's go back to the way it is correctly. So that's the percentage of sales method, kind of the easy way. You notice you completely ignore what's sitting on the books already for allowance for bad debt. Let's call this for bad debt so we don't have confusion. And we'll call this allowance for bad debt. But it also has the other name, uncollectible accounts. All right, so let's come down here. Let's use the aging now, aging of receivables. Aging of receivables means that we're looking at outstanding receivables, and we come to the conclusion $7,000 will not be collected. Notice the amount's identical to here. Okay, I'm doing this so you can see the difference when I highlight it. The difference is that when you're using the aging of receivables method, you have to factor in the existing balance that's there. So there you got a debit balance of $3,000. Now the problem that's going to present for you is when you fill up the allowance for bad debt or allowance for uncollectible accounts tank so that you can draw from it in the future, you fill it up with a credit. The problem is you've got a debit of $3,000 in that account currently. So the only way to get this allowance for bad debt up to $7,000 is you have to make an entry for $10,000. Notice that you make a bad debt expense entry for $10,000, factoring in the $3,000 that's there. You will have to keep in mind credit $3,000 to get a debit back to zero, and then you're going to have to credit another $7,000 to get up to not $10,000, but to get up to $7,000, because it took this entry of $10,000, the first $3,000 just gets this debit up to zero, and then the next $7,000 gets it up to what it should be, and that is $7,000. Again, this is focused on the balance sheet. Okay, this is not focused on the income statement, it's focused on the balance sheet. Write that down. When you write stuff off using this, once you set up this bad debt expense to tell the outside world, hey, we're outside world, we're not going to collect this, and here's the tank we're filling it up with. This is a contra account to the receivable, because you're going to have accounts receivable minus how much is going to go bad. You basically, when you write stuff off, is the exact same way. There's no difference there. What you do is, let me just copy down because I'm trying to highlight that things don't always change. In this case, if you write an amount off, you debit allowance for bad debt. Again, you're lowering the amount that you put into this tank, just like you did up here at the top. And you take the receivable off the books. Obviously, if you're not going to collect the receivable, you take it off the books. This is two different methods. This is the easier one by far, because basically whatever needs to be, whatever is estimated to be uncollectible, you just drop it in here. If this was 1% of $1 million, you just take $1 million times 1%, you make this entry based on sales. So you don't have to worry about the balance sheet, you don't have to worry about anything but what is sales, let me make my entry. When you're working with aging your receivables method, though, it's a little more complex because you have to say, hey, well, how much is in there now, and what do I need to do to get that to zero? Keep in mind, let's say, for example, just so we can be cognitively flexible here, let's assume that instead of a debit, this was a credit balance. Instead of a debit, let's assume it was a credit balance of $1,000. If it was a credit balance of $1,000, you need to get to $7,000 as far as a credit is concerned, because you fill up the tank with a credit. You've already got 1,000 though, so you would drop this entry down to 6. And at 6, because you're already at a credit balance of 1,000, you just need another 6,000 to get to 7,000. This is the two methods we cover in course. I hope that you found this, this analysis of both methods useful.